Welcome to the REI Hacker Podcast, where we unlock the secrets of real estate success. Join us as we dive into the journeys of top investors, mentors, and industry experts. And now, let's hand it off to our host, Benson Juarez.
Welcome, everybody. Thank you so much for being here on this edition of the REI Hacker Podcast. My next guest is Sam Morris. Sam is the CEO of Sunset Capital. It's a vertically integrated real estate investment and asset management firm based out of Houston, Texas. He's got over 23 years of experience in real estate. He's led acquisitions and disposition teams on transactions exceeding $550 million. Welcome, Sam. Thank you so much for being here. I really appreciate your time.
Yeah, Benson, great to get to learn about you and know a little bit more about you, and hopefully get to share some nuggets of wisdom today with you. So
yeah, I love it. We were just chatting a little bit, but your experience comes from the corporate banking world. You were in that world for over 18 years. What was it that caused you to venture into the syndication world?
yeah, it's kind of funny. I started, as a young banker right out of college, fresh and, right out of school. And what I learned is that, man, there's some deals that are out there that really people are making a lot of money on. And so from there, I started learning who the players were in our local market and started to go, wow, maybe I should invest with these guys. And so I started as a passive investor, just like a lot of our listeners on this show and a lot of people that are investors with us. All right. So yeah, where I started. I started at a young age, which was very fortunate, right, to be able to do that. A lot of times we talk about these things and going, man, I wish I would have started investing, 10 years before today or whatever, because obviously pricing was different and things like that back then. But what I learned as a young banker, and from being an underwriter on all these deals too, was how people were making money with these deals. And it didn't take me long to be able to go, oh, wow, who are the players that are doing this in my local community? And to start to introduce myself to them, and became a passive investor myself, right? And so that's actually how I got started in my 20s, was actually passively investing into deals, and actually seeing how it would work out, and knowing what deals to get into because I knew how to underwrite them, right? And so being a banker, it kind of gave me that, that little vision. You see the world through those lender eyes of, oh, wow, this is how this is going to work, and this is how these are able to perform, right? And so I started at a young age actually investing as an LP into a lot of these deals, specifically multifamily, and those were larger deals at the time, right? I would say at least 100+ unit type complexes in areas that I knew and was comfortable with sponsors that I knew and was comfortable with. And so that's actually how I really got started. And that was back in, I call it 2007. So, 18 years ago now. So
That's pretty exciting. What a unique position to be in. And this is kind of a weird, I never thought of it before, but was there any sort of conflict of interest that, you were making decisions for the bank to lend on properties, and that you could potentially be influenced to, move a file forward, knowing that you could invest in it? Did that discussion
not
ever
at
come
that
up?
time. Yeah, I was low man on the totem pole at that time. I really didn't have any kind of decision capabilities at all. I was just the underwriter. And so my job at that time was really just, putting deals together and things of that nature. And so really where it became really interesting is, and I have, guys that were lending clients that are now part of our ecosystem. And so it was how we developed a lot of relationships too. And even to this day, I still sit on the board of a bank, right? So I actually sit on the board of a bank, a local community bank here in Katy, Texas, which is West Houston, right? And so some of the benefits of that, because it's really hard to get out of your system, right, is I also, being on the board, and being a director, I actually get to sit on loan committee. So all the deals, not just real estate deals and not just apartment deals or storage deals, or but all the deals that come in, I have the ability to evaluate, and that's really real-time data Like that is, here's what stuff's trading for. Here's what people are paying. Here's what they're having, here's what they're looking like in the terms of loans and things like that. And you get to see all of it in real time of what's going on, right? And it's, a lot of guys say it's our cheat code too, because we really get to see where population is moving, who's developing what, and things like that, and things that are even around those types of real estate. And so it's actually, it's great from a local perspective to be able to go, wow, I really have a good understanding of what's going on, where things are going, who's going into what, and the true cost associated with those projects.
Yeah. I guess that makes sense for people who, as they grow professionally, and what's the benefit of sitting on a board, right? Like, maybe there's a little bit of a stipend, maybe some board members are making some good amount at some of these larger, big,
Yeah, we're a
publicly
small
traded
bank.
companies,
We're tiny. Yeah.
right? So you're not making much, but it's worth your time there, because now you've got the kind of this inside track to, seeing what's going on in the market, and potentially even having some influence on what the bank does, financially. Is this the same bank that you helped start?
Yes. So yeah, so I'm what they call the founding director, and so we're part of the group that helped start the bank. We're still in what's called de novo status. De novo just means from zero, and it means the bank started at zero, right? And we're just shy of about 300 million in assets now, which sounds big, but in the banking world, that's actually really small. And we're about almost 2.5 years old right now and making money as a bank, which is great. One of the other things that we get to do and have conversations with are our federal regulators. And if you think about that from the perspective of how valuable that's been really the last few years too, a lot of them have great insights because they're federal regulators as to what the Fed is thinking or going to do with interest rates, or how they're looking at jobs reports, or how they're looking at things that absolutely can impact, some of the macro level items that, impact real estate. And so
Right.
really having some of that knowledge from that perspective and being able to go, okay, so that's kind of what they're thinking right now. It could help from the perspective of it adds to or augments the information that's out there, and helping us make decisions that are hopefully wise for our investor base.
Oh yeah. Well, having that as part of your bio, when you're presenting to a new investor and they're like, well, why should I trust you with my money?
Sure.
You're
Yeah,
like,
no, I mean,
all
look,
of this, like,
history is
overwhelming amount of
is
information.
another, right? But it's still, brass taxes. If I'm going to give you money, investor wants to know, one, are you going to be able to protect what I'm giving you? And two, are you going to be able to return it plus more with what we're putting it in? And hopefully we're able to articulate why that would be the case and why we see what we see, and have the information or the factual data to back it all up. And so, our typical investor, I would say is more local, and by local I mean state of Texas. And a lot of them are fairly technical, and so they like seeing the numbers, they like seeing the analysis that we put into all of this stuff, and we have the ability to convey, the messaging is, all right, here's why, right? Let me show you the data and put it in a format where they're able to understand it. And then just show the business plan associated with those deals as to why it's going to make sense for them or not, right? And look, I tell everybody there's always another deal, and not every investment is appropriate for every single person. I mean, there's just different types of investors, right? Some really want to know that they're going to get cash flow, right? And that's all they really care about, is what kind of money am I making on the money I put in. And others just say, hey, I want to know that if I give you something at the end of X amount of years, I've doubled my money, or whatever it may be. Whether I'm making money along the way or not. And so everybody has a little bit different parameters of how they're going to invest. And, what we hope to do is to be able to present something that they can easily go, yes, this fits within the way I want to invest, and then being able to move that investor into those deals.
Yeah. So you've got all different perspectives on this, cutting your teeth in the corporate world, and then, transitioning and starting a bank. I don't know. How did you even get to a point where you thought, okay, I've done everything else. I'm just going to start a bank now. Like, how does that idea even come up?
Yeah, I mean, well, it was my background, right? So I'd
Hmm.
actually done it before and been a part of many bank organizations that had sold. We sold our last one back in 18. Um, and it was at that time when I really decided, hey, you know what, I'm going to do real estate full time. Um, I had a tremendous amount of contacts, obviously, from being in that world for 18 years. And um, it's really when some of the guys that I knew from our last institution said, hey, what do you think about doing another one? Do you think you can help us from a syndication perspective, help us raise some money, and join the board and help us build the team again? And, we go and do it again, right? And I'm like, well, yeah, this sounds great. And so as far as the amount of work that I had to put into it, I would say it's minimal. I mean, most board members would probably be the same way. I mean, it's varying degrees of what you got to do, but once it gets set up and established, it's management's turn to take over and run it from a day-to-day
Right.
perspective. I mean, uh, I would say as far as involvement in the bank, I mean, 4 or 5 times a month, I'm probably up there doing things, whether it's meeting on committees or having a board meeting or um, whatever aspects. I mean, there's a lot of committees uh, through the banking world, believe it or not, that
Sure.
that I sit on. And so it's not just loan committee. We have what's called ALCO, which is your asset liability committee, and that's literally the balance sheet of the bank and how we want to grow the bank and what types of deals we would want to take more risk on or not take any more risk on, and pricing of those things. Um, and having just, yeah, I mean, it's one of those things that's very comfortable for me because I've been in that world before. And so, it's just a lot of people, it's just different, right? But yeah,
Yeah.
we're a brick and mortar bank, so it's a bank, and it's been harder to do too. I mean, we were the 50, if I remember right, like the 57th granted charter in the entire country in the previous 11 years.
Wow.
So it's just they didn't hand out charters a lot in the last decade. Let's just put it that way. And a lot of them were specialty. And so we really had a business plan that we sold to the FDIC and the state, and they were like, okay, this absolutely makes sense. There was this huge consolidation when we sold back in 18. Not many community banks were out there, and so I mean, really a great need, in particular for Houston.
Hmm.
For more community banks, not unlike Denver too. I mean, Denver has a large um, community there too, where community banks can thrive. I mean, it's needed because we have a lot of small businesses in this world, and
Yeah.
community banks really service a lot of those.
Yeah. It's an interesting world to be in, but I see like it can be a big advantage moving into some of these newer like transition areas where there's, interest rates are volatile, they're changing all the time. There's a lot of talk about a bunch of commercial loans coming due, right? Some
Yeah,
balloons that are coming due, and you getting to see some of those opportunities first. Is that one of the playbooks that you have in place here to
yeah. We
look at
actually
the
we put
assets of
one
all these other
out yesterday.
banks?
Yeah, I mean, we put one out yesterday directly to the lender, who we've been talking to for several months
Hmm.
on this particular deal, and we finally were able to go, all right, hey, here's what we're going to do. And um, what I tell people is real estate, and a lot of real estate people know this, we have our own vocabulary, right? We have terms we use, we have acronyms we use, and it's a different vocabulary and different vernacular than what normal people talk about. But the same is true in the lending world. They have a different
Hmm.
vocabulary, and the way that you speak to them is absolutely critical, in particular when you're talking about what we call ORE assets, right? Assets that they've taken back, non-performing assets, and how you speak to them and what you can get out of it is really critical. And so when we're talking to those lenders, we would do things where these are effectively toxic assets. Lenders
Right.
do not want assets back because that's not the business they're in.
Right.
You now have money that's dead money because it's not earning anything. You just have it in an asset that we call non-performing assets. Therefore, it's not performing. And so you go to them and be like, hey, if you have a non-performing asset and it fits our bucket and our investment thesis, maybe we can work out a deal where I can turn that non-performing asset into a performing asset for you. Um, and so, yeah, absolutely, it works out that way. But you have to use appropriate language when you're speaking to them. You have to show them why it's in their best interest to deal with you. And you have to show them the path of how you're going to be able to take them out, right? With the least amount of impact to their balance sheet.
Mm-hmm.
And in the same time too, understanding that depending on the type of lender, they may have regulators or other people on the other side telling them, you got to move this like now, or you're going to have to find other ways to make sure that you are getting rid of these assets, or we don't want you lending anymore in this world, things of that nature. And so there's all different ways to skin the cat when you're dealing with that too. Like I can tell you the LOI we put out yesterday, it was, hey, here's where we're at, guys. From a valuation standpoint, we know what you have it on the books for. We're going to need your help here, but we're willing to help limit your loss to this. And the reason we're willing to help limit the loss to this is because as part of this offer, we actually want you guys to lend us this. So we'll pay you down to here at this interest rate. So I'll dictate it all, telling them, all right, and we'll do it for a 2 or 3 year term so that we can work your way out of this, guys. And otherwise, if you sell now, you're going to get here. I'm going to help you not lose as much money in this particular deal, but I need you to help me by lending me appropriate funds to get this project back up to an appropriate level at an interest rate that's far advantageous to what probably market rates are today. I'd tell you that. And this is how we're going to be able to work out of this together. And I'll help you limit your losses, and you're going to help me be able to get into the deal and make sure that you get repaid in a timely manner.
So are these properties that they've taken back and they own already?
This particular one.
So you can get a combination of some owner financing and then some new loan debt, and
I'm
those would
having them
be
do it all.
different
So
rates.
in the offer, they're doing it all.
Yeah.
Yeah. And really what I'm doing is I'm saying, look, the longer, and i.e. the longer you wait, the more deterioration is going to occur because, the management you have in place or don't have in place right now, I mean, there's going to be a continued decline until you can get somebody professional in here. Let me help you guys, stop this bleed as fast as I can, help you limit your losses, right? And let's start building it back up. And so they get creative too, because they can actually work all kinds of deals. I mean, they can even be part of the equity in the deal. I mean, we really worked a lot of different ways with lenders. And so, in this particular market right now, that's probably where there are a lot of opportunities too.
Yeah. It seems to be a pretty big opportunity in the next few years to grab some of those assets and get more favorable terms and, basically leverage all the things that they'd have to do. And you don't have to spend as much on the acquisition side, resource wise, right? From like marketing and, having people out there just, going through all this stuff.
It goes beyond that because they take it back, right?
Mm-hmm.
We'll request, show me all the phase 1 environmentals you guys did when you did the loan. Show me all the third-party reports that you guys already have out. This, like, it's part of our due diligence. And we go, all right, now instead of going out and buying brand new for all this stuff, if you guys want to get this updated, split the cost with us or something. We literally can actually close it much cheaper than a normal transaction, and they're okay with it because they're already in title and they're already in the in the chain of title that way. And so
it's in their best interest to do it quickly.
Absolutely.
Right? At the
help
least
me
cost.
get the due diligence done fast, and now I've taken this non-performing asset and made it a performing asset for you. And now you don't have to worry about any regulator coming in or trying to say put a bigger loan loss reserve to it, which impacts your balance sheet and things of that nature.
Mm-hmm. Explain that concept, a loan loss reserve. What is that about?
Yeah, so every time a lender, in particular a bank, makes a loan, right? There is a certain bucket of money that they have to put over here going, all right, hey, we have a percentage that we're going to have to put over here as future loan loss reserves, right? Because as we grow our portfolio, they're not always going to pay, right? That's just reality of it. And we may have to take a deal back, right? Well, we could be impacted when something goes bad, right? And we got to have a pool of money over here to be able to protect that. right? So that we don't have any disruption of loans and deposits and things that we have going on or anything of that nature. And so, we put aside a certain dollar amount to do that. Well, as we recognize the deal could be even worse than what we thought, that reserve may have to even go higher. Now, to put it this way, as soon as you go up above a certain percentage, the lender's no longer making money off that loan because so much of what they're making and more, a lot of times, has to go to that reserve. Therefore, they're not making any money on that loan. And so when you're able to take that asset that's considered a bad asset, which they may even have to write down a certain amount, they're going to take it from that pool of a loan loss reserve to cover whatever losses that they have. And so if you have somebody who's coming in who's very cognizant about that and going, hey, let me help you turn this into a performing asset, right? Well, maybe they don't have to pull as much out or even add as much to that loan loss reserve, which just helps their balance sheet. And so having the understanding of a lot of this too and how that works is why I say that vocabulary is different and why it can be very helpful in this kind of environment. And yeah, it's a competitive advantage that we have because of the history and the relationships that I already have in that world.
Right. That's pretty interesting. And what's cool about this too is that once you've built the relationship, like you're just kind of in. You just have to prove that you can do it once with them. And now they're probably knocking on your door, like, Sam, we got this other asset.
They're going to
got another one back.
Absolutely go back to whoever has helped them before, as long as they know, hey, this person has the ability to operate this out, or you just want to be top of mind, right? And so I wish I could say, yeah, it's always going to work for every deal you're going to do, but some of them just don't work within our investment thesis, right? So it could be in an area we don't want to invest in, or it could be a type of product that we just don't want to be messing with, or it could be too small or something that it could all be, a whole lot of things, but I still want to be invited to the table there. Right. And so, would we, if it's something where they're like, man, we got to do whatever we can do to get out of this, we may take a stretch or do something that's even outside the box just a little bit if we know we could just make a lot of money on it. And, to an investor, a dollar's a dollar, right? So if you double their money, they don't care if it's big or small, as long as you double their money.
Right. So in the syndication world, you've said the word investment thesis a couple of times. So investment thesis is kind of like your business plan, right? Like how you guys operate as a fund, what kind of assets you go after, how do you manage those? What's the exit strategy? All those things.
Every deal individually. We actually have not done a fund. We've toyed with doing funds before, but it's just been a lot easier for us to do deal by deal, and it's very easy to describe to an investor, hey, here's what we're going to do, and here is what you're investing in. So for us, right, we're kind of in both pockets. So we'll lead GP or we'll co-GP deals, and we're in two verticals, right? So we're in multifamily and we're in storage. On the multifamily side, we have a little over 1,700 units. On the storage side, we have a little over 2,000 units. And really, for what we're trying to do, we're really solving to a return. And so what I would tell you is we're more an investor-centric business. I tell people all the time, like, everything's for sale. I mean, I'm married to my wife and that's it. Like, if somebody's going to come in and give us a whole lot of money for an asset, even though it may be before what we were thinking we were going to sell, but we can make a lot of money for our investors, it's sold, right? We will absolutely flip out of deals quickly if we need to. And it makes sense for our investor. But really what we try to solve to is to 2xing money within a 5-year period. I mean, that's really what we try to back into. And we've been trying to do that with a little bit more higher quality assets, I would say, in the last year. So really in the last year, our focus has been more on, if it's an apartment, say on this side of 2,000, right, a certain amount of units, and then what really is the value add that we can bring to it that's going to be able to justify that, whether it's, we're working, paying at a higher cash flow on an ongoing basis, or we really see this being just a deep value add, right? A lot of the deep value adds, I would say, are out of the market. We just really haven't seen a lot of those in the last several years. I would say we did multiple transactions last year where we brought what's called an HFC to it, or PFC, which is a tax abatement strategy to the deals. And so there's an affordability component that you bring to the apartments when you do that. And that was actually, really successful for us last year. And one of the great things that did is it enabled us to start paying cash flow rather quickly to our investors because of it, a substantial amount. And it was a significant value add to the property because of that. And so there's different ways to do value add. It's not just you go in there and you change the carpet, change the color, and update the countertops and the appliances, the old school way of doing things. There's a lot of different things you can do to truly add value to properties. And so we look at really all the angles associated with that, of how we're going to be able to enhance the return. And if we're spending capital dollars, how we're going to be able to get the returns associated with those capital dollars, and to be able to articulate that to the investors.
Let's talk about some of those additional value add strategies besides just, putting money into the property to increase the quality of it, right? What are some of the other things you do besides like the straightforward, like, replacing management, lowering costs, increasing rents?
Yeah. I mean, it's that's kind of the, that's kind of the end game, right? It's really what is it that you're doing to get to that point? And a great example is like what I just told you, the HFCs that we brought into, we did 4 deals last year, which is we worked with the local housing authority. I mean, this is something that's a little different, a little unique, to bring an affordability component to a conventional property, right? So it can be
What does HFC stand for?
HFC is it's effectively you're bringing a financial corporation, so it's public financial corporation, PFC, housing financial corporation, and you're bringing in effectively the local government to come in and you're going to ground lease it, effectively the property. You're going to have and because of that, you're going to turn a certain amount of units, right, to an affordability component, meaning, all right, hey, I'm going to reserve a certain set of units. Let's just say it's 30% of the units to be 80% of the AMI, the adjusted median income for this area, meaning those that make less than 80% of the adjusted median income, we're going to lower the rent. You heard me say lower the rent to where they can actually afford it and be able to live in this area. Now, where that really works well is, you hear about affordability crisis, you hear about not having enough affordable units, right? Where it really works well is we have certain areas, let's say you have a suburb and it's a higher end suburb, right? And let's just say the average rent there is $1,800, which doesn't sound like a whole heck of a lot, but when you're paying a local teacher $40,000 a year, she or he is not going to be able to rent in that particular apartment complex. And they're in an area where they're serving, right? Another example, one we just closed on, was right behind a hospital. And yes, the doctors could probably afford to live there. However, the maintenance techs and the x-ray technician and some of the nurse aides, they wouldn't be able to make enough money to live in that complex, which is really close to where they work and has all the retail and things associated around it. Well, when you bring this HFC to the property, right? The benefit to that for the property is it may take say $1 million a year tax bill and lower it down to $200,000. So it's a big, big number, right? And when if you learn cap rates and things of how you're going to be able to handle that, what that does is it's pretty tremendous. And it'll go, all right, here you go. We're going to lower your tax bill down to this, and you're only going to be paying X% from here on out because of this structure, as long as you stay in compliance with this structure, right? And so that's a tremendous value add up front to the property, right? And I didn't change anything with it other than the way that we are going to lease units. We're going to have a more diverse community, right, within that apartment complex from a socioeconomic standpoint. And you're going to have really something that's probably more representative of the area of people that are there. And you help address some of the affordability issues associated with it. So huge value add. It's a needed community program, and our investors are going to do well because of it, right? And so a lot of the investors love doing that because they sit there and go, oh, I'm actually helping with the affordability crisis that we have. I mean, in the state of Texas, there was a report put out, I think last year by the comptroller who said, hey, we need over 300,000 units for affordability just for the state of Texas. And so
Wow.
you think the bulk of that probably being in the major metros, right? Houston being one of them. And so there's no way for us to go build 300,000 affordable units. And so this became a program that's very viable because it enables us to help address some of the affordability in already established areas where a lot of these people already are trying to live, or where they already, work, or where they already, like to play, whatever it may be, in areas where it's needed because they don't have anything like that around there.
So is it possible then that one of these tax credits or tax benefit programs that you're talking about is better than if you could just rent it out full price? Like if everyone's was paying the full market rate of the rent, you could still get a better ROI on an investment into this opportunity
I would say
by
it
taking the
depends.
tax benefits rather than just
I would
renting
say
it
it
at
depends.
market.
For the properties we did, yeah, it absolutely made sense because of where it was at. You didn't have to adjust the rents too terribly much to get it down to what would be needed to stay in compliance. Um, but then there's others that will tell you, hey, if you're doing that, you're going to change your buyer pool a little bit too. Meaning somebody coming in going, man, I maybe don't know how to run a property like that, or I maybe don't have the ability to stay in compliance with something like that, and therefore that value to me maybe not as much as it is to somebody else. And so what you're seeing, at least in today, is that I think it changes the cap rate a little bit on the exit. And what I mean by that is, let's just say it's a 6 cap market for conventional straight deal. The property that has an HFC or PFC on it, it might be, say, 6.25. So you might not be able to get as much value as if you didn't have the program. The thing is, the NOI difference enough, you would hope that the NOI change more than exceeds that increase, or that incremental increase in cap rate. And I know I'm speaking really specific there on certain things, but effectively the value that you add by making your expenses lower should exceed if you ran it just conventional and you didn't have that in place. So
Right.
that would be the downside to it, I should say, or where it kind of levels it out a little bit more.
But
one
creative enough to where you're not
Creates
letting
cash.
opportunities slip through your fingers. Like you're looking at all these opportunities across your desk and you're underwriting them from all these creative angles that the average fund manager or asset manager doesn't have. And so
Correct.
that provides additional value back to your investor pool.
Yeah, and I mean, I would tell you, we do underwriting very well. I would also say we dig into things probably a lot more than others. I mean, being an ex-banker, I'm conservative by nature, and so I'm always going to lean a little bit more on the conservative side, and it means we say no a heck of a lot more than we say yes. And so for me, I don't want to do a deal just to do a deal. I want to do the right deal, if that makes sense. And
Yeah.
so I don't want to see there and buy a problem that we're going to have 5 years from now or 3 years from now, whatever it may be. Right. I want to know that, hey, you know what? We have a lot of exits and a lot of outs for this particular deal once we get in, and we do things. It sounds silly, right? You sit there and you go, oh, well, that makes sense, right? So say we bid on a deal and we win the deal, right? After we close, we'll go back to the broker, right, and go, hey, now that we've closed, tell me everybody that was bidding on this. I want to know the groups. And the reason being is, if they're interested in it now, there's a chance that these same groups will be interested in it 5 years from now, or 3 years from now, whatever it may be. And so we're going to watch and go, all right, who are our potential exit partners in the future? And our first list is the people that were bidding against us in this particular deal. And so we want to know who those exit partners are and really keep up with them, making sure, all right, hey, are they still on the market? Are they still looking for the types of deals that we're looking for? Are they really going to be there when we're looking to sell? And it doesn't necessarily mean that's the person you're going to sell it to, but it's important to know who they are, right? So that you know how to structure deals when you're looking to exit and things like that. And if you had to sell for whatever reason, you know who you can go to. So,
Oh yeah.
but not a lot of people do that, right? Not a lot of people sit there and go, all right, who was bidding against me, right? And a broker will share at that point because the deal's done, right? I mean, it's really nothing information to give, but you want to know who those people are and what other deals they're looking at, because those could be future exit partners for you.
Yeah, I mean, it just goes to show, as people start to grow, professionally, like a lot of the lower level stuff that you have to worry about just becomes so habitual and second nature that you're not focusing on the basics. You can think of high level strategy, and all that affects the bottom line of your investors. And, to think, okay, 5 years down the road, like they're just thinking about, well, what's next? What do I got to do tomorrow? What do I got to do next month to make sure that this property cash flows,
Yeah.
not
From
5 years down the line?
side, yeah, I would tell you from an asset management side, one of the biggest things that we tell people, in particular for our multifamily projects, and let's just say we've got a $50 million multifamily project, right? I will tell people for the most part that the $75,000 a year that we spend on the property manager at this property, she or he is the most important person in this scenario, because you're literally giving them a $50 million business and telling them, this is the business plan that I want you to execute on, right? And that poor person is extremely important, because they're the ones who are literally executing upon the vision that you built, right? And I mean, I can say from an asset management standpoint, all right, yeah, here's what we're going to do and how we're going to do it. But the person who's the boots on the ground, who's going to execute that plan, really is one of the most important people in the whole ball of wax of everything. And being able to get the returns that you're looking for, and being able to execute upon the plan that you've created, and the follow-up and then the support for that person is tremendous. I mean, it has to be. And so those little things that you talk about, I mean, there are certain things that I would say, yeah, they may be little, but it's big in the scheme of things. It's just a lot of stuff. I mean, you and I were talking earlier. I said, we have a lot of passive investors who started out active. I mean, they wanted to get in there and do it themselves. And then they, fairly quickly realized, my gosh, this is a lot more work than I ever anticipated. And there's so much that goes into this, and the level of sophistication has just gotten far above, their pay grade, that it becomes much easier to stay passive and allow the professionals who are very good at what they do just do what they do well.
Right. What are some of the strategies that you've used to get that boots on the ground person to buy into your vision, and not just think that they're just some employee who's there to check in and check out, but it's really looking out for the best interests of the project?
Yeah, I mean, we literally make them part of the business plan. We will sit down with them and go, look, you are key to this. It's a follow-up thing too. I mean, every week we're talking with our on-site teams. And I would tell you, it's one of those things to make sure that we know that it's going the way that we anticipated. But a lot of times I'll also tell you, as asset managers, we see a lot of things in the numbers that tell the story. A lot of times we'll tell people, we read numbers the way you read words, because the numbers tell us the story. We may not have all the qualitative data behind it, but it'll absolutely tell us what's going on. And so when the on-site team knows, hey, we're here to help, we're here to support, we're here to, help you succeed. That's when it really becomes, it's normally firing on all cylinders, because they know they got the support of everybody behind them to be able to go and succeed. And a lot of times too, we're looking, because they are the boots on the ground, we give them a lot of rope and going, look, your resident base, the tenant base, what's going to happen in this local market. We're sitting over here looking at numbers from an office. So if there's suggestions, understand that not only do we want you to tell them, or not only do we want a dissension of opinions, meaning we want a lot of different opinions associated with it. A lot of stock will go into what you say because you're the one there, and you have a lot of power associated with that. When you're empowering the people, it becomes really big. And we're still a smaller company too, so if if decisions need to be made, or we need to make a pivot, whatever, we can do that today, kind of thing. And all right, here's how we're going to do it, and that becomes what the new rule is, right? And so having that flexibility and support behind them, a lot of people really are able to buy into it from that aspect.
Oh, yeah.
And it's really just figuring out what the motivations are, right? There's some people that are money motivated. There's some people that are praise motivated, right? You just have to figure out where that motivation is, and utilize that.
Have you ever carved out any equity for anybody that was like a key person?
Yeah. For sure.
Yeah.
For sure. In particular, when we do a refinance or something like that, where we're able to do a big cash pull, they're getting healthy numbers. I mean, we have a storage deal right now that we're in lease up, right? So it was a C of O deal, meaning brand new deal. And man, she made a pretty good sized bonus at the end of last year because she hit a metric that we put out there. It was a big carrot. And I mean, it was a significant bonus for her.
That's great.
And why wouldn't we, right? Why wouldn't we want to share that? And from an investor standpoint too, you sit there and go, wow, this person, if they're far exceeding where expectations are, right? The amount of what that translates to you guys from a cap rate perspective and value perspective, yeah, let's go ahead and, give her a piece of the pie where she's going to be really happy because, fast forward a few more months, if she is able to help us sell that deal months ahead of time or whatever, it changes the IRR for everybody in the deal. And so absolutely, we would share the wealth that way.
Oh, yeah. I think it's a great strategist in general to take care of people. A lot of the people who are, just a cog in the machine, they don't get the recognition, and that starts to build, some negative feelings, and you just don't want that building up. And, especially in the corporate world, right?
Yeah, it's you do well, yeah, and you will see it too every now and then. I mean, we paid an on-site property manager a pretty big amount of money because she hit a goal. I mean, helped us do a refinance, and it was a big equity pull for everybody in the deal, right? So investors were well taken care of, and so, but she helped us get there, and so we paid her a pretty good amount. Well, her regional manager, her boss, effectively, her direct report boss, saw what she made and came up to me and was like, I'll go down to the property management level and go do the next one. Like, please, this is amazing that you were able to pay her that. And it was like, no, I mean, she deserved it because she helped us earn a lot of money.
Right.
And so we absolutely want to, share the wealth. And I would tell you, it was not an expectation thing. That was a little different. She was not expected to do that. And so it was just, I'm going to do everything I can. And we did say, hey, we're going to make sure you're taken care of. You help us with that. But it blew her mind. Like, this is amazing.
It's fun to write big checks for people, right? And seeing
it's fun.
How they appreciate it.
I mean, who wouldn't want to do that? Yeah, it's great.
Well, there are people out there that don't think the same way we do. But honestly,
you can't do it by yourself. You have to.
Those are the people that don't make it, right? They're the ones that eventually get burnt, right? What comes around goes around. And if they don't have other people's best interests ahead of their own, right? Well, essentially, you're fiduciaries, right? Like, you should put their interest, meaning the investors, right? Interests above your own. They make money before you do, but that just translates in all business.
Sure. No, I mean, and that's the thing. I mean, that particular instance, it was we made a lot of money for the investors. It was a lot of money for the investors. And so we just took a small portion of it and gave it to the people that helped us get there. I mean, that doesn't seem difficult or wrong in any way, right? Everybody was for it. It was one of those things like, no, this is a good operational call to make to take care of the people that just took care of us.
Yeah.
Seems logical to me. And it's fun to get to do stuff like that. Absolutely. I mean, in some cases, this can be very much life-changing money for the on-site people who really sacrificed a lot to help you.
Yeah. I love it. I mean, obviously the goal of every investment that we put together is to make people money, but it doesn't always work out that way, right?
Sure.
Is there a deal or an investment in your past that you're just not too proud of, or maybe it didn't have the returns that you wanted? Or
Yeah, absolutely. We're selling one right now. And we'll probably, I mean, it'll be maybe making just a little bit of money, but did not hit projections. And there were a lot of reasons why, and it was a lot of things that were outside of our control. And you call it COVID, supply chain, whatever you want to call it, right? But I would tell you that everybody in that deal, because we probably over communicated, to be honest, just, hey, here's where we are. This is what's going on. It was a lot more, this is what we're going to try to do. Everybody has a good understanding of what it is. There's not like a, darn it, you guys couldn't get what we're at, but it was more of a, hey, I understand this is absolutely some things that were outside of your control. And in that case, you really just gotta turn communication up tremendously.
yeah.
And really almost, I try not to be annoying about it, but just go, hey, look, here's where we are today. And let me tell you all the things that we've done the last week on all of this, or, we let them know that we're on top of things of that nature. And so, yeah, I mean, I've also was a lender back in 08 and 09 and things of that nature. And so you sit back there and you go, I had battle scars too, right? I mean, I've learned from others' mistakes and how they did things. And that's probably one of the better educations is during that time frame, I absolutely learned what not to do. I watched other people of how decisions that they made, what they decided to do, who panicked, who did what, oh my gosh, who made that kind of decision and what the ramifications were associated with that. And so you learn a lot through going through a few cycles of mistakes that you're hopefully sitting there going like, oh, hold on, I'm not going to make that choice because I saw what's happened in the past. And that's where the gray hairs come in, right? And you sit there and you go, all right, I've been there, done that, and seen what happens, and we're going to go this way and not that way, guys.
Yeah.
And so, yeah, I mean, absolutely. I tell people all the time, nobody bats 1,000, and if they do, they haven't done it long enough.
Right. Yeah.
And the
Wait
guys
till they do their second
the
deal.
guys that have battle scars are still probably very worthy of being investing with, just because they're not going to make those same kind of mistakes that they've made in the past.
Right. Yeah, there's something to be said for, seeing the pros and cons of all the transactions. Cause like you said, what not to do as well. And the people that have batting 1,000 have only done one or two deals, and something's going to happen eventually. And
Sure.
they won't necessarily have the foresight to be able to identify that negative when it's coming. It could be right in front of their face, but
Mm-hmm.
you don't know what you don't know. So
Right.
that tenure is certainly valuable. But the same could be said for investors, right? You've worked with lots of experienced investors, and when things aren't going as well, they're like, you don't have to be on the phone every day with them because they understand that's the business. But a newer investor is like calling every day. What's going on with my money? Right.
Yeah,
So
and so that's part of why I say the way we communicate with others, in particular when things aren't going exactly according to pro forma or something of that nature, we really want to be able to give them kind of that consistent update of here's what's going on, guys, or here's why we have deltas, and try to explain here's what's and really it's not more of a, hey, here's the problem. It's more of a, hey guys, here's our problem, but here are the three things we're going to do to go ahead and overcome this, right?
yeah.
We've gone down these routes before, and our anticipation is this will fix X, Y, or Z. And so and that's where having some of the operational experience really just is beneficial in something like that, to be able to alleviate some of those concerns.
Yeah. What advice would you give somebody who is newer? who maybe hasn't invested as an LP in a deal, but they're thinking about it. What's some advice you can give them as far as like what they're getting into and what should their expectations be?
Yeah, honestly, I'd first say educate yourself. I mean, there's so many groups and clubs and meetups that are out there, and really just start to figure out who in your area where you're going to be comfortable, does deals that you can be comfortable with. And, there's different schools of thought. I mean, people will tell you, you just got to jump in with both feet and go and invest in a deal. I would actually tell you, it's probably wise to actually figure out and learn the business a little bit before you just jump in and put your hard-earned dollars into it, right?
Mm-hmm.
But if you can learn and educate yourself just a little bit on how to do some basic underwriting, just a little bit on how to understand some of the deals that are out there, and there's so many resources that are out there that will teach you all this stuff for free, and find where those resources are and speak to you. And then when you're comfortable doing something, going, all right, this is it. I'm going to go ahead and make a jump. And I found a sponsor I know, like, and trust, or I found a group that I know has done this before. And I'm going to jump into their next deal. That would be what I would say. I mean, before you put money into a deal, put it into you and get the education you need, before you go jump into something like that. And like I said, there's tons of groups and meetups and, investor groups that are out there that you can get the education that you need.
Yeah. Yeah, I think it's key for them to do that. But again, this is why a lot of people invest passively into deals. It's because they don't want to go learn it all. Like they just want to find somebody that they can
Yeah, but you got to
trust.
have some kind of base knowledge, right? I mean, you want to have some base knowledge, right? If
Mm-hmm.
you think about it with almost any investment tool, you go out there and you go, all right, I want to go invest in a stock, right? You're probably going to want to know what that company does, or at least a little bit about it, before you just go, all right, here you go, and here's money.
Yeah.
From a passive standpoint, you know, I would tell you, I mean, the super majority of the money when we go put out another deal is a repeat investor, because there's just people that continue to invest with us in every deal we do. It is a very honoring thing. I mean, we do not take that for granted, but I can also tell you they don't have necessarily, they're not going to probably read every word of a PPM.
Right.
They just have had the long tenure of investing with us to be able to do that. And there are people that absolutely would sit there and go, look, I know, like, and trust you, therefore here you go, and let's see how that works. And as we're doing this deal, I'm going to continue to learn and educate myself. Fantastic. I mean, there are a lot of people that do that. You just have to understand you're into that deal now, and now you really need to be able to understand what that deal is doing and how you're getting paid from it, why you're going to get distributions the way you're getting them, things of that nature. And so, and it runs the gambit, because we have people that are highly technical that are part of our investors, to some that are, I would say, are so highly passive, they don't care. They're just, here you go, here's the money, and I don't, tell me when it sells, and everything in between, right? And so,
Oh yeah.
I still think it's wise, even as a passive, just to educate yourself a little bit so that you know what you're getting into, right? I mean, our minimums are anywhere between $50,000 and $250,000 into deals. And I mean, if you're going to give somebody $50,000, that's a lot of money. I mean,
Oh yeah.
you sit there and go, that's a lot of money to go ahead and put into a deal. I would think that you'd want at least to know a little bit about the sponsor, the GP in the deal, and what you're investing in, right? And so having some of that education to help you with that and evaluate that, I mean, personally, I think it was wise. But again, I lean more conservative on that ex-banker, and so I like to know a lot of things before I get into them. And it's probably a big reason why so many people trust us, because we're pretty diligent before we ever get into a deal.
Yeah. No, I think it's good advice. I was playing a little bit of devil's advocate there. But it's just good sound advice to know what you're getting into, do your research, do your due diligence, make sure you worst case scenario, if everything goes sideways, that last 50 grand isn't going to ruin you, right? Like make sure that you've got some liquidity to where if you lose that money, it's not the end of the day.
Yeah, and understand that they're illiquid. I mean, these are illiquid investments. I mean, when we syndicate deals and we're putting it into real estate, it's not like you can just trade it like a stock or a bond and go
Right.
get your money back tomorrow kind of thing. these are typically, you've made this investment and you're in it for the time period of the whole period associated with that investment. And so having an understanding of that, is tremendously helpful.
Yeah.
So, and then
there's some people who are probably
watching Vincent's show on a continual basis as you continue to educate your listeners. It's a big deal. I mean, that's another avenue of education, right?
100%.
Yeah.
Yeah. And that's the goal of, this is to show different aspects of all kinds of investing strategies from, single family all the way up to large multifamily. But for those people that have listened to you, Sam, and are interested in potentially looking at some of your opportunities or want to learn more about you, how can they connect?
Yeah, best way is to come to our website. So it's sunset-capital.com. From there, you can log into our platform and you'll be into our ecosystem. We put out a monthly newsletter every month, and and then when we do have deals that we offer, that's actually the ecosystem that you'd have to be able to see those in. And so, we have a lot of things on our website where, we have due diligence checklists and things like that you can download for free. And so it's, we want educated investors to be on our platform. So it's sunset-capital.com.
Very cool. So keep an eye on that. If you have the ability to check out the show notes of the podcast, we'll put that link in there for you so you can go connect with Sam and his team. But Sam, thank you so much for taking the time. I mean, you got so many things going on, and I know that getting your face out there and still finding the opportunity for people to get to know you, like you, and trust you is part of the process. But we really appreciate you kind of sharing your background and giving us some insight into some of the ways that you make deals happen.
Yeah, honored to get to meet you and be on your show, bud. And I really do appreciate it.
Awesome. Well, everybody, thank you for being here. Go check out Sam. You can just tell he's a straight shooter. He's got an amazing background. You're not going to find many people in the syndication world that have his kind of underwriting experience. So that, I will tell you, is rare. So make sure you check out him and his team and take a look at some of his opportunities, and also keep an eye out for really cool and amazing guests like Sam on future editions of the podcast, where we bring in real estate investors and educators and mentors and service providers and just people that are making exciting moves in the real estate and business world. So check those out, and we'll see you next time. Take care.
Thanks.
That's a wrap on today's Real Estate Revelations. Thank you for tuning into the REI Hacker Podcast. Remember, every property has a story, and every deal is a lesson. Until next time, keep hacking the real estate world.